One of the more positive surprises for Tesla stock investors from its latest quarter was the increase in profit margins. Both gross profit margin and operating profit margin expanded by much more than was expected by Wall Street, and especially much more than I expected, given Tesla's struggles with sales and how much incentive and promotion it had to offer to generate sales growth. Still, I don't think those profit margins will persist, and I'm going to share with you in this video why I think that's the case. So let's get into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So let's start by looking at the profit margins and how they increased in the latest quarter. So in Q3 2024, you'll notice total GAAP gross profit margin came in at 19.8%, which if you compare it with the third quarter of last year, was up by nearly 200 basis points. In the Q3 last year, Tesla's gross profit margin was 17.9%, so a 200 basis point increase in gross profit margin. Similarly, if you look at operating profit margin, that increased by 10.8%, up from 7.6%, in even more impressive increase in the latest quarter. This increase in profit margin, I believe, is the primary reason why Tesla's stock price bounced up by more than 20% following the earnings release. One of two things. The other thing was the company saying that they expected 10 to or 20 to 30% vehicle growth next year. And so these profit margins were a surprise, given that in the third quarter this year compared to the third quarter last year, Tesla offered significantly more promotions and price cuts, financing options, etc., to get these cars sold. And so they're selling at lower average selling prices, and yet they generated more gross profit margin. So let's take a look at some of the details from the CFO's perspective of Tesla and understand why these increases in profit margins are not likely to persist. So the CFO saying that while they had unit volume growth, they did experience a reduction in average selling prices, primarily due to the impact of financing incentives. And they're offering huge incentives here. If you think about it, on a $40,000 car, if a company gives you 0% financing when the financing is, usually at 7%, that's a huge incentive, right? If you're paying 7% interest on a $40,000 car, that's roughly $2,800 in interest annually. Let's say if you have a 5-year loan, that comes out to be roughly $15,000 in interest expenses over 5 years. So that's the going market rate. Now, if you take that and you subsidize it and say, we're going to offer you 0% financing instead of the going market rate, you're basically offering buyers a roughly $15,000 benefit. So a $15,000 price cut. Now, it's not apples to apples in that way. You've got to consider the time value of money, and the cost of offering those lower financing options may not be as much as I'm estimating here. But just to get a general feel for how valuable an interest rate deduction might be to a car buyer, you can understand that's a pretty big incentive here. So Tesla saying that we are providing these incentives primarily using third-party banks and financial institutions, and we recognize the cost of these incentives as an upfront reduction to revenue. So instead of looking at the sale as $40,000 in revenue, if the company is offering a, let's say, financing option that reduces the cost to a buyer by $15,000, they'll count that as $25,000 in revenue. So they'll subtract that right off the top from the revenue, and then from that revenue number, they'll subtract the cost of goods sold to come to the gross profit margin number I shared with you earlier in the video. Now, here's where I get to making that prediction that Tesla's margins will not persist. The company saying here, our focus remains on growing unit volume while avoiding a buildup in inventory. Growing unit volume while avoiding a buildup in inventory. To me, that points to more price cutting, more incentives to get things sold to me, that doesn't look like profits are in focus. To me, that looks like they're trying to sell more units. And one of the ways Tesla sells more units is by offering more promotions and incentives. And when they do that, that's going to lower the average selling price. And unless they have a similar decrease in cost of goods sold, that's going to decrease the gross profit margin. And then, unless they get an increase of unit sales to offset the impact, that could lead to a decrease in operating margin as well. They go on to say that to support this strategy, we're continuing to offer extremely compelling vehicle financing options. So that they're going to keep offering these compelling financing options. And then they just flat out say it right here. Sustaining these profit margins for the fourth quarter, however, will be challenging given the current macroeconomic environment. So Tesla basically saying that these margins that we generated here in the third quarter, they were surprising even to us, and we don't expect them to continue in the fourth quarter. And we think that they will likely decrease given our focus on just selling more units, and we don't expect demand for these electric vehicles to be so strong that we can sell them at these margins. We think we're going to have to lower prices. We think we're going to have to offer more incentives like financing options to get these vehicles sold. And we're okay with that because we want to focus on unit growth right now, and we're not so focused on profit margins. And Tesla has the luxury to do that because they have the best profit margins of any EV manufacturer. They've got huge advantages, competitive advantages in the scale, in the learning curve. Remember, Tesla's selling pretty much the same models, if you exclude the Cybertruck, pretty much the same models that they've been selling for so many years now. So every year you produce the same car, you get better at production. So you're able to remove some cost, you're able to produce them a little bit faster, you're able to negotiate supplier agreements for longer term contracts because you know you're not going to be updating that model, so you can get 6 years worth of inventory agreements and so on, right? So their cost of goods sold, and they highlighted this in the latest quarter, is in the mid 30,000 for each vehicle. So they can offer these cars at five, six, $7,000, maybe even $10,000 lower than where they're currently selling it at, and still generate a positive gross margin. And then Tesla will hope to make profit from those sales later on down the line, maybe by marketing supervised self-driving, maybe by marketing maintenance services, maybe by marketing something else to those buyers, some software update, some software upgrade, and putting pressure on competitors. And so far that's worked because we've seen a significant decrease in new supplies of electric vehicles. In 2020, 2021, 2022, you had so many electric vehicle companies enter the market, fueled by government incentives and investor enthusiasm that gave these companies billions of dollars. And that put pressure on the industry overall because you've had that increase in supply coupled with a, I would say, unenthusiastic increase in consumer demand. I know demand for electric vehicles is increasing in the US, but not by very much. And if you compare the increase in EV sales this year versus last year, and then you add into that mix how much government incentives and rebates and tax credits had to go into the industry to generate this marginal increase in sales year over year, it really demonstrates a weak organic demand for these products. And so these profit margins unlikely to persist here doesn't take away that Tesla reported an excellent quarter in their latest quarter. Their profit margins, gross and operating margin, increased meaningfully, and the company has the luxury to offer these promotions and incentives to generate sales and put pressure on competitors to not add a new manufacturing facility, to not develop a new model, to not spend money on research and development. And longer term, this will be good for Tesla because the industry will be in better balance. And Tesla, like I mentioned, can afford to do this because they've got excellent profit margins. They've got great competitive advantages in the cost of production. So long as consumers continue to be willing to pay to purchase these older models, these long in the tooth models, then this will work for Tesla. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.